Hello, I'm Donald Leggett, and welcome to the latest FocusIR London South East Investment Trust interview. I'm joined today by Charles Jillings, Chief Executive at ICM Investment Management Ltd. Charles is responsible for the day-to-day running of Utilico Emerging Markets Trust and has over 30 years of experience in international financial markets. The Utilico Emerging Markets Trust has delivered an annualised total return of 9.3% over 17 years, with a 3.8% dividend yield. Welcome, Charles. Thanks very much for joining us today.
Donald, thank you for the introduction and very good to join you today. And I look forward to sharing thoughts and insights on Utilico Emerging Markets.
So let's start by asking you a very broad brush question, Charles. Why emerging markets, and in what way do the economics of those emerging markets fundamentally differ from developed economies, perhaps those economies that investors are more used to?
So emerging markets, I think a simple answer is they have strong GDP growth. If you looked at China, 1.4 billion people, it's growing over 6.5%. If you looked at Vietnam, 100 million people, it's growing at around 4.5%. And so it goes on. So most of the emerging markets themselves have strong GDP growth. And how are they achieving that? They are unlocking the potential in their markets through a number of factors. One is a clear vision from government as to what they're trying to achieve. So if you looked at India and the Modi government, they're crystal clear on what they're trying to achieve in terms of the infrastructure and the investment in, if you want, education. So most emerging markets are focused on the enabling their economies to compete globally, and that means education and that means infrastructure. Those combinations with strong GDP growth make it a good place to go as an investor.
And why utilities and infrastructure? Why that niche?
A little bit answered before. They in order to out the value, they need to invest in infrastructure and utilities, and it's an ongoing process. So if you looked at India again, they have freight corridors that they have built and put in place, which are only really becoming operational today, and that means that if you want, the economy can work at a faster speed. Before, if you had freight, it had to go onto the railway tracks, and it came, I think, third or fourth behind passengers, behind local freight, etc. And successive governments in India have built dedicated freight corridors, so you can now export goods from, if you want, Delhi to Mumbai in a much quicker time. Before, it could take you 4 days, it could take you an eternity if it got pushed onto a siding. Today it's dedicated, double stack, efficient. And if you think about the impact of that, not only is it quicker, but people don't need to carry so much inventory. Before, motor car manufacturers would have to stock goods at the port because they didn't know that their supply chains were resilient enough. And that sort of vision and that sort of investment unlocks value for us. And we can see it in the ports. We can see it in the logistics businesses.
It allows just-in-time production, you mean?
Not quite, but it certainly speeds it up. But if you want, the whole world is becoming more and more efficient. So shipping lines are engaged with ports. Ports are engaged with their customer base, and that just enables the supply chain to be much more efficient.
Okay, you mentioned infrastructure megatrends. Infrastructure megatrends are a big thing for you. Specifically, energy transition, growth of digital infrastructure, social infrastructure, and global trade, as you were mentioning there. So why do you expect that strong growth to continue in emerging markets? Why is that those are the trends that you're focusing on?
So I think if you looked at globally, there is, if you look at global supply chains, there is a move to nearshoring, and that's a reflection from COVID, where if you want, suppliers are looking to bring the production closer to the client base, because the experience of COVID and the disruptions was almost fatal for a number of businesses. So bringing it closer, bringing it more under control is a big drive. And I think, these 4 megatrends are here for the next 10 years. I can well see that investment decisions around manufacturing will always now look for resilience. So what we're not seeing is, if you want, the global industry withdrawing manufacturing from China. But what we are seeing is where they have a decision to make, they are relocating the next investment, say, into Vietnam. So, as you've probably read, Apple are locating some of their new production facilities into Vietnam. And that's just a good business decision. We're seeing the same in Mexico. Tesla are looking to put a gigafactory into northern Mexico. And all that's reflecting is resilience of your supply chain. And that'll go on for some time, because the first person will arrive. You'll then find that the supply industry will shift to be next to them, etc. And so it generates its own momentum, and it generates its own, if you want, mini economy. And if we can understand those trends, then that's exciting. And if I touch on digital, when Apple announced their new product, I'm excited. What does that mean? There are more and more people going to develop apps and applications, and there are going to be more and more people capturing digital information. All that needs data centers. All that needs fixed communication. So, it's an exciting growth opportunity. And again, I see that being there for the next 10 years. If we talk about social infrastructure, a few things to note. Some of these countries' geographies are historically unhelpful to them. So if you looked at Mexico, huge number of mountain ranges. Historically, people took buses. It would take you 24 hours. It would cost you a lot. With the rise of, if you want, cheap airlines and the development of airports, people are now flying and much shorter journey, cost less, much more pleasant. So you can see that the investment in the social infrastructure, the airports and those sort of assets are going to drive a long-term trend over the next decade.
When it comes to picking your stock picks, when it comes to developing your portfolio, how do you actually reflect those long-term trends?
So we're bottom-up investors. Yeah, so we like to properly understand a company's business model, and that means trying to understand communication links. It means trying to understand what are the real drivers for that business, be it passengers, be it containers, be it motor vehicles, and the decades of investing allow us to have quite insightful frameworks that we can apply. If somebody came to us and said, "Oh, we operate the port and it operates at 80% EBITDA margin," we would be, show us how. There's something missing here. There's something doesn't quite feel right. But if we look at the longer term trends that are driving the economies, they should drive our investments. So bottom-up investors, we build out business models, we test them with management, and quite frankly, a lot of the time, something will start out as a small investment, and until we get comfortable that we both understand it and management continue to deliver against expectations.
Okay. Is it worth giving us a sense of the breadth of your portfolio, just in terms of the range of geographies?
We tend to approach it on the basis of how do we achieve resilience in the portfolio, and by diversifying geographically and country to country, and by diversifying sector by sector, we think that gives us resilience. So it's a competition to get in the portfolio. We're an investment trust. We have limited capital. And that competition is healthy because it means that we do challenge our existing investments because we need to sell something, and we do challenge investments that we do make because they have to be compelling at the time we're making them.
How many stocks are you invested in currently?
Roughly 80, 85, and that historically has been pretty consistent. From time to time, we have a sort of effort at reducing it, but the reality is, I think, that there's always new opportunities. There are always new things to invest in and add to the portfolio and give us that resilience.
Okay, yeah, you've got almost 23% of your portfolio in Brazil. What are the economic attractions of Brazil? What are the fundamentals which are driving your interest, and what are the great companies that you're discovering there?
Brazil is has a population of 214 million people. It has, if you want, enviable infrastructure and momentum. But like the rest of the world, it still needs to invest out the opportunities that are in front of it. And it has, a lot of ambition. And if I look at their economy, it's no different than anybody else's. They need to increase the sort of renewable supply. So what does that mean? It means that they need increased transmission. Most of their new renewable energy will come from northern Brazil, and most people live in southern Brazil. So there's a big need for infrastructure. And just sticking with that, in our top 5 investments, we have a company called Alupar. Alupar is an operator of transmission lines. And why are we excited about them? 2 things. One, fabulous management team who manage their existing assets and consistently meet their expectations and our expectations. But the exciting part is that Brazil is auctioning power lines as we speak. They had an auction last week for 3.5 billion of new power transmission, and that enables companies like Alupar to bid and win and then deliver those projects. And the strength of the management team at Alupar usually means that they can deliver ahead of budget, ahead of time. And those 2 factors mean that the IRRs that they were expecting at the time of the award, they usually improve upon. So it's been a fabulous investment for us. And over the next decade, I can see continuing investment in this space will be needed. And Alupar, with their strong discipline, they don't bid for something that they don't genuinely believe they can achieve the returns that they want. They'll back away. And so, we have lots of faith in them and are excited about them. But if I look at a different aspect of Brazil, they if you want, sewage and waste is poorly treated. If you look, most waste sites are unlined. The waste just gets dumped by the local council, and of course, as we all know, it leaches into the water base and contaminates, quite frankly, the local community and the environment. The government, about 4 years ago, brought in a law which requires everybody to operate proper waste sites. Horizon is a new investment for us. It's in the top 5. And the excitement here is we have a management team who understand the waste industry in terms of how you need to line it, etc., how you operate it. But they have the opportunity to buy a number of waste sites and improve them and drive high performance from them. I think the added benefits are that they qualify for credits in the international market, and that has value. They can also capture the emissions, the gas emissions, and turn that into energy. So there are a number of revenue streams and profitable investments that they can make, which will deliver an outperformance, and it's a compelling investment. And again, this is going to take 10 years at least to play through as they buy new sites, push them into, if you want, proper operating metrics and performance.
Okay. Let's turn to another of your portfolio holdings, which is China. 15% of your portfolio is held in China. Where is China at the moment? What are the structural trends there? It was in COVID lockdown. How is it recovering from that? Put China in context for us.
So China, I think, is the one that probably occupies the most time at the moment in terms of what do we think is happening. It's definitely not bounced as firmly as we would have anticipated, and it does look as though it has some challenges. That said and done, I've always believed that the Chinese government ultimately has the ability to drive the economy, and I think it'll come down to their determination, and I think they can achieve it. But at the moment, it's difficult to see how they balance out. If you want a number of conflicting outcomes and expectations. Our investments in China are nonetheless focused on data centers, as we all know. Despite the wider economy, that subsector is growing very, very quickly, and we're seeing it in the data centers. Or it's focused on gas distribution. And as with any other major economy, China is looking for more and more, if you will, or lower emissions energy sources. And so gas distribution is still receives high support from the government. The one thing I would say about China is you almost need to sit down, understand their 5-year strategy, understand their 10-year strategy, and then invest alongside them. And if you can do that, usually we can make good returns.
Okay. Talk us through some of the other Utilico Emerging Markets portfolio highlights. So that's Brazil. You've given us China. What else is in there that we may not be so familiar with?
So I think the shifting to nearshoring is something just that I find fascinating. You know, very often these topics are discussed, and how do you evidence them? One of the things we do is we travel, and in March I was in Mexico and went to Monterrey, which is a city linked to, if you would, northern Mexico, linked to the U.S. economy. And they are seeing phenomenal growth. If you go and look at the industrial warehouse sector, 100% let. You wouldn't see that anywhere else. And as I mentioned earlier, you were seeing Tesla put a mega factory into northern Mexico. All these things will generate huge momentum for Mexico itself. I was surprised that Mexico has overtaken China as the biggest exporter to the US. I didn't think I would see that. But, you are probably seeing a shift of, if you want, the supply chain and nearshoring. So Mexico is a very interesting market for investments like logistics, airports, ports. So, we've got a number of investments there which are exciting. And as I mentioned before, Vietnam, is seeing a strong uptick in their performance. And you have to remember with Vietnam, 100 million people, I think the average age is under 35, highly educated, very capable, very numerate, and engaged in the global economy. So again, as investors going in, there are a number of tailwinds which help us.
So on a practical level, when you're managing the portfolio, on average, how long do you invest in those 80 to 85 stocks for? Tell us what you look for and how you manage that portfolio.
So I have a fabulous management team sitting underneath me who have a sort of subset specialism. So Jacqueline looks after infrastructure, ports, airports, toll roads. John looks after utilities, power, water and gas. Mark looks after communications. Mobile, satellites, data centers. And the idea is, if you want bubble up, we have a very active engagement, very active discussion. And the selection is very often just a discipline of, we've got something that's compelling. How do we fit it into the portfolio? Do we have the cash to buy it? If we don't, what do we sell? And so it's a competitive, if you want, process to get into the portfolio, and we then monitor it against benchmarks that we've set, including ESG.
Okay. Utilico Emerging Markets Trust has been operating for 17 years. Talk me through performance in terms of NAV, performance in terms of share price, whatever metrics you choose. You choose the metrics and explain to us about your performance.
One thing to note is, while we will quote the MSCI, it's mainly because everybody else wants a reference point. We don't look at it. I always deliberately say, if somebody sat me down and said on a maths test, give me the constituents of the MSCI, I couldn't do it. I don't pay attention to it, but we report against it because others want to see that. We're bottom-up investors. We're looking for a total return, and over time we've beaten the MSCI over 1 year, 3 year, 5 years since inception. The end of May, I was. It's not a benchmark, but our total return since inception is close to 400%, whereas the MSCI is somewhere down at the 260. So it's been a good performance. I think two other things to underline: the volatility in the portfolio, because of the nature of the assets, is low. So our beta is under 0.7. And our year, we because of the nature of the businesses, they're operational, and they pay a dividend, and that we can pay to our shareholders.
Okay, a final question for you, Charles. Why should retail investors invest in investment trusts broadly, and in particular, why your one? Why Utilico Emerging Markets?
So why Utilico Emerging Markets? At the moment, we're standing on a near 15% discount, which is very frustrating. I would say our underlying portfolio is also on a discount. Markets are underpricing the quality of the assets across the spectrum, and our assets are no different. So cheap portfolio, big discount, we're paying a yield. You can sit still and wait for the performance to come through. I think why investment trusts? I think investment trusts can trade through political and geopolitical cycles. We've got a set of capital. I don't need to make a decision as to, are we in emerging markets or out? We're not. We're in. We'll remain 100% invested, and that's the strength, because it means that we can take the long-term decision, which marries perfectly with the asset base we've got.
Okay, and that was a great answer to end on. Thank you so much, Charles Jillings, Chief Executive at ICM Investment Management Ltd. That was absolutely fascinating. We learned a lot there. Thank you very much indeed for giving us an insight into the Emerging Markets Investment Trust. For more company information and to access the company bulletin board, please go to the Utilico pages of London South East. And meanwhile, do follow us on Twitter at London South East, or register on London South East YouTube to receive alerts to more Utilico Investment Trust interviews like this one. Thank you so much for watching.